Modeling and valuation for mutual funds. It's quite different from hedge funds. Quite different. You definitely have much of a longer term focus, 3 to 5 years, and sometimes much, much longer than that. And it's an easier way to invest because you don't have to worry about volatility or quarterly results as much. You do have to worry about them, but not as much. Okay, so they kind of focus on the longer term. They don't really focus on a catalyst as much. Before they enter a position, they might want to ensure that there are multiple catalysts coming up in the next 3 to 5 years, like Walt Disney releasing new versions of Star Wars every couple of years or so. So they're looking for longer term catalysts, not near term catalysts. And there's much less of a focus on sentiment or technicals. In fact, most mutual funds don't care about technicals at all or technical analysis. And if they do, it's usually the trader that just uses technicals to size a position or to get in a position or to take a little bit of profit or vice versa. And so there's definitely much more of a focus for mutual funds on discounted cash flow, but only if the portfolio manager is a value investor or a GARP investor. And so you got to know your client or your boss. And so on the left side, again, we have value investor. They like to buy cheap stuff. On the right side, you got the growth investor. They like to buy expensive stuff. And in between, you've got GARP or growth at a reasonable price. And the way they approach modeling and valuation is quite different. Okay, so you have to know the investment philosophy of your boss or the portfolio manager. Okay, so how's it done? Well, let's see if they look at DCF. Value investors love DCF. GARP investors, sometimes they like it, sometimes they don't. I mean, if they're a little bit more value-ish or a little bit more on the left end of the spectrum, they might like it. If they're close to the right end of the spectrum, they probably won't. I know it sounds a bit elusive, but this is the way it works. And then with growth investors, they don't care about DCF. There's too many independent variables. It's too long-term focused. There's too much value being placed in the terminal value of the DCF for a growth investor. Okay, now in terms of price to revenue, value investors don't like that. They love to focus on earnings or cash. And when it comes to GARP investors, it all depends. Again, if they're closer to the right end of the spectrum, they'll like it. If they're close to the left end of the spectrum, they will not like price to revenue. And growth investors absolutely love price to revenue, especially expensive companies that don't have earnings today, but will in a couple of years. Price to revenue multiples work well. When it comes to price earnings, all three of these investors love to look at PE. It's also my favorite investment methodology valuation framework. Okay, so what we're going to do is we're going to take a look at valuation on our three metrics here. But before we do that, let me go to my model here. I want to just kind of show you how it's much more important for analysts in the mutual fund sector to be focused on valuation on an annual basis. Okay, they might look at quarterly in the near term, but annual is what makes much more sense for them. And of course, they'll forecast the income statement. They'll also forecast the balance sheet on an annual basis, right? Let's get rid of these guys because they look out longer term. Go away. There we go. All right. And then in the cash flow statement as well, they'll look out longer term. Okay. And that will all feed into the DCF or discounted cash flow analysis, which we discussed in great detail. Okay. And then the valuation metrics again looks like this. Let's go back to our presentation. So again, there's three different valuation methodologies that you can use. And you can use many, many more. You can also use EV to EBITDA, price to book ratios, etc. If you have more questions on that, please let me know. Okay, so there we go. We've got all three valuation methodologies. And then at the bottom here, we take an average of all three to get to our target price. And I love the triangulated valuation approach where you have three methodologies just in case one is wrong. Okay, it minimizes the margin for error. Okay, my investor or my portfolio manager in this case is a value investor. That's Mo, the superstar mutual fund analyst. Okay, so his PM or portfolio manager is a value investor. Obviously, he ignores price to revenue. He focuses on cash and earnings, hence the DCF and price to earnings. Okay, so let's take a look at how Mo would value a company, LinkedIn in this hypothetical example, right? So he hates price to revenue. He'll look at price to earnings and price to book. And so quite simply, he'll take a look here at price to earnings and he'll look out 5 years. So he'll discount that price target until today, okay? and he'll discount it using the weighted average cost of capital. And then he'll also do the same thing for discounted cash flow, right? And we've covered that before. Okay, so now if your portfolio manager is a growth investor, what do? Well, you ignore discounted cash flow analysis in most cases. Now, there are exceptions. But most will just look at revenue and earnings multiples. Okay, so we can just ignore DCF in this hypothetical example. Okay, cool. So we can also do a bit more of a sensitivity analysis based on what we think the market environment is going to be like: bullish, bearish, or just right. Remember Goldilocks and Three Bears? We like just right. Okay. And so let's do it. Let's take a look at the price to revenue multiple valuation for a mutual fund analyst. Okay, so at the left-hand side there is the price to revenue chart. Here's the bullish scenario. And he usually looks out 3 to 5 years, whatever it might be. He looks out longer term. He doesn't really care about earnings as much this year, I want to say. Okay. So he'll look at those 3 price targets based on revenue multiples that are 10 times, right? And what I prefer to do, though, is look at different scenarios. The bearish price target is going to be here, right? But I always like to look at the middle of the road price target, because I don't know what the market's going to be doing then. So that's 7.5 times revenue, and that's that amount here. And then you'll discount that using the WACC that we calculated in the previous sections to get our target price there of $355, okay? So in 5 years, based on our price to revenue analysis, we think the company is going to be worth $484 a share. That's 7.5 times revenue, okay? And then we'll discount that back to today's price. Okay, cool. There you go. Now let's move on to price to earnings valuation. And again, the analyst likes to look 3 to 5 years out or whatever it might be. Okay, longer term. That's all I want to stress here. And let's assume that we look at 5 years out and the price earnings ratio there is a PEG of 1.5 times in this hypothetical example. And you discount that back using the same methodology as we used here to get a price target today of $319 using price to earnings. So here we have the price to earnings price target at $355 and the price to revenue price target at $319. And we simply take an average of both. And there you have it. Your price target is $337. Okay, so the bottom line is this. Every mutual fund and portfolio manager has a different approach to modeling and valuation just based on price targets. If you're a value investor, you look at cash flow and earnings. If you're a growth investor, you look at revenue and earnings. And if you're in between, you'll look at maybe a combination of all 3. Okay, it's a little bit subjective. So you got to know who your portfolio manager is and what their investment philosophy is. You also have different dimensions based on if you think that the economic cycle is positive, neutral, or negative. And you can create your price targets based on that as well, or positive execution for the company or negative execution for the company, right? It just helps you to hedge your risks.